Not straight down and then straight up. The S&P it's about 1% off its highs. Same for the Dow. The Nasdaq has been underperforming by comparison. It's about 6% off its highs. And so I guess the burning question is this a big, top that's been forming since the middle of last year, or is this the market setting itself up to blast off the new highs? And I think the thing of trying to look at past examples, these historical examples are less relevant today than ever before, simply because the QE factor is a major factor. The saying "don't fight the Fed" does hold true, but now it's a matter of don't fighting, as we've written many times, don't fight the Feds, in plural, the multiple central banks that are all gang tackling the money printing machines, making sure that as much is being printed as possible, so the liquidity remains, especially in the face of Brexit and its uncertainties. Bank of England has said that they will go ahead and they're probably going to be reducing rates one more time. And I think they're awfully close to getting negative, going negative in rates. We've got other countries that are sitting with negative rates. A friend of mine who was heading up the Goldman Sachs trading desk for about 10 years, Pam, she wrote in her, she mentioned actually, she actually wrote this out. Basically, the real story is that investors are so frightened or so short of safe debt to buy that Switzerland can borrow for 50 years at rates below zero, Germany and Japan for 15 years, and France and Holland for 9 years. Roughly 10.7 trillion of sovereign debt, which I think it's more than that now, but she says 10.7 trillion of sovereign debt and 1 trillion of corporate debt is now trading at negative rates worldwide. And this is uncharted territory for these central banks. It's a very bad situation to be in because the banks, these entities, these structures that exist, are designed to exist with positive rates, not negative. And when you go negative, you create havoc. Pensions are one example, insurance companies are another. And you threaten basically the foundation that was built to support these structures. And I think, it's in keeping with what Ed Sekoda's talked about in Duopoly, we're at the 39th day, so that's one day off the end. And notice Ed says in one of he gave an interview with Michael Covell, and Ed Sekoda doesn't usually grant interviews, but Michael Covell, if you don't know, he's the best-selling author of a number of books, but in particular a book called Trend Following, which I've read, Gil's read. It's a great book. He interviews Ed and other very successful traders in there, and the fact of the matter is that the system we're in is in the process of collapse. Ed says it's not death, it's not the end times, but it's a big transformation, which I agree with. And there's of course a lot of opportunities that can emerge when the world changes as quickly as it will be changing. So that's all in keeping with where we're at. The volatility that has been amplified this year will probably be here to stay because there's too many issues and uncertainties that are not going to go away, and they're going to probably rear their ugly heads every so often. So QE can go ahead and push the markets higher. Maybe we'll get some sort of a run to new highs. But then, we're going to get some bad news. It could be a political issue, it could be an election issue, a global economic issue, and that will create knee-jerk reaction from the markets to sell off. And we've seen this pattern a number of times over the last year. And that's fine. I mean, we're still, we're not just surviving, we are, there's certain ways to make money in this environment, and they have so far been at our beck and call. The art of being nimble is very key, as we've talked about many times, because this is not your grandmother's kind of market. This is very nimble type of environment. You've got to be quick. There's quick in the day, and at the very least, it takes people's trading skills to much higher levels, because this is a great learning environment to create discipline within yourself as a trader. And outside of that, we've got the commodities are, for all intents and purposes, it looks like they are, they remain in their uptrend. They've been going sideways for a little while now, but the uptrend still remains intact. And gold and silver, of course, they're shooting new relative highs as the I think confidence issues grow with our respective governments. So basically, you guys just keep a very close eye on your positions, because anything you have out there, is liable to have sharp corrections as we've seen. So it's important to take profits where you have them and keep your stops tight. That's the basis of the VIX volatility model, where it can have a series of very quick signals that can be either small losses or nice profits, depending on the markets. Usually volatile markets are friendly to the VIX model. But you can also have trending markets, which are very low volatility environments, which are also good, where the model will just sit on a signal for a number of weeks, as we've seen. Going forward, this volatility is see it as a friend, because it's definitely not like the 70s, where William O'Neill, I remember, telling me that it was very difficult to make any progress in either direction. Well, he was a long side guy, but no one was making progress in the mid-70s because the markets were so dead. They were very flat back then. So at least we have the gift of volatility. With that, I will go ahead and turn it over to Gil.
Well, it's still a pretty choppy market. The way I would approach this here, if you go back to the last couple of webinars where we talked about the possible undercut of the May lows by the indexes after the Brexit vote, and how you had an undercut and rally, and there are a number of stocks that could have been bought on the undercut and rally, for those of you who know how to implement that. But it's basically a corollary to the short side of the market, where you use undercuts of prior lows in stocks to cover short positions. So example, now let's see. Here you have BABA breaking down and undercutting the low, and then it turns around. So we talked about this undercut and rally phenomenon before, and so that's what you got coming out of the Brexit vote. This is where you were. You were up here around 40, close to 4,900, around on the NASDAQ before the Brexit vote. Everybody was looking for a big, the UK remaining in the EU and looking for the market to continue moving higher. So it was here before that news hit, and you basically now have shaken out. Okay, so what does that mean? Well, it means you can rally back up to where you were before the Brexit vote, and that's what you've done. In yesterday's action, you had a sell-off in the morning, and you held. The NASDAQ held the 10-day, but really what was key, I think, in holding support was the S&P, because it was closer to the 50-day. NASDAQ was sitting between the 200-day and the 50-day the day before, and so it broke down on a gap-down move, undercut, and then staged this big bullish-looking outside reversal to the upside. Now that looks pretty bullish. You can't really deny that looking bullish, but you come up very sharply for 4 days back to normalized levels, let's say pre-Brexit levels, and then you're going to test or you're going to consolidate this a little bit or digest it, whatever you want to say, for a couple of days, and that looks normal. And then you get the support when things are looking pretty ugly yesterday, which was the case early in the morning. But a lot of stocks are just coming right down into areas of potential support and could be looked at as potentially lower risk entry points, depending on what names you're looking at. Like, for example, you got BABA here, which I just showed, has rallied back up above the prior highs here in the 50-day line after the undercut and rally, which also coincides with an undercut at the 200-day. So notice how this really tries to fake everybody out, and it does, because I'm sure at this point 2 Mondays ago that everybody was thinking this market is cooked and we're really going to blow to pieces. But if you're looking at it objectively in this sort of volatile QE nutso market, you look more for the undercut and rally. So people ask me, well, why aren't you looking for the market to break down? In the old days, I might have. But these days, knowing how this market operates and that it's generally just this big pool of sloshing liquidity, and it sloshes over one way and sloshes back the other way, and that's essentially why you're just getting this long-term range. It looks like this on the NASDAQ, and that's why you're getting this. So I think the dynamics of this market are pretty clear, and you need to understand them. That, and I've talked about this many times, right, Dr. K? We've talked about this a lot. There are no systemic inflows into the market anymore. It's just QE. You don't have baby boomers saving for retirement like we had in the 90s, or you don't have a net movement of household ownership in equities from an extreme low like you had in the 80s to an extreme high like you had by year 2000. And so you don't just have those natural asset flows back into stocks, or money flows back into stocks as an asset class relative to others. So you don't have that anymore. The whole retirement thing now is out the window, with mostly, baby boomers are pretty much retired for the most part. I think I'm the tail end. I would count myself as semi-retired, sort of. But in any case, nobody's out there throwing money into the stock market on a regular basis. I guess, what would the term be, Dr. On a secular basis? You don't have any secular trend here. You've had the flow of QE, which has been continuous since 2009, and that's driven the market high in choppy fashion. But maybe we're reaching a point where all QE does is cause the market to slosh back and forth. And so all you have to play are these moves. And so we try to play them, and you have to use every trick you have up your sleeve, and one of those tricks is playing undercut and rally type moves. And you can see this would work in Alibaba, but now it's at the top of the range. Maybe it becomes shortable. I'm looking at the NASDAQ today, and yesterday's action looked bullish. I mean, you can't really deny that from a strictly technical perspective. But what are you doing? You're zigzagging your way back up into the highs, into the pre-Brexit zone. And you're actually getting a rally the day before the Brexit vote results were going to come out in anticipation of the UK staying in the European Union. And that didn't happen. That surprised everybody. And they all panicked. Everybody jumped out the window that day, it looks like. And every stock on the planet looks like this for the most part. You have two huge downside days. So then you zip right back up once everybody realizes that the Brexit does not mean that the end of the world is in early onset stage. Although it may be the 40th day, but we don't know for sure. And so now you're back up here. Now the market's like, okay, what do I do? And I think you're seeing a little bit of that today with this choppiness ahead of tomorrow's jobs number. Dr. K, you have any take on the jobs number tomorrow? Do you think it's going to have any influence on the market, or the potential outlook for the Fed?
That'll have as much influence as the last one did, unless it's a real shocker. I mean, the last one was pretty heavy, and it just either it pushes the Fed. If it's a very strong report, it helps the Fed make a case for interest rate hikes sooner than later. And I think that this data is pretty nonsensical overall, and it's just the Fed jawboning in terms of whatever the report says. So if it's strong or weak, it's pretty irrelevant. I think the Fed is really, their hands are tied, and they have really no choice but to keep rates where they're at, or even to lower them at some point. And I think well, given the way things are, I think central banks have no choice but to keep printing. They can't afford for the interest rates to start climbing, because that will create overburden of just the interest rate payments alone on the debt. So yeah, these central banks, like we've said many times, they've painted themselves into a very tight corner, which is somehow growing tighter and tighter. Maybe it'll become singularity or something. But it's not a good situation for the world, and it's quite unprecedented. And Greenspan had noted in a recent speech, a recent interview rather, and this is a man who's very underspoken, that Venezuela, he used that as an example, that that country's government is failing miserably and it's moving toward martial law, which is rule law and order by the military. It's a highly corrupt situation. But he said also that the U.S., UK, these other countries are not that far behind. He doesn't mean it's going to happen tomorrow or next year, but he said these are unprecedented times, and the situation is quite dire. So maybe over the next several years, according to, I guess, the schedule of the history of the world, over the next several years, I think we are going to see some dramatic changes across the board.
So all that means is that you don't think the jobs number is going to have much effect on the market?
Well, a lot of these numbers really don't have much of an effect at this point.
Right.
I think QE rules the day at the end.
Yeah, I mean, last time it didn't really do anything, but then the market did start to sell off, I think, shortly thereafter. When was the jobs number announced on... By the way, am I coming across okay? Someone's saying that my voice is breaking up. Is everybody hearing me okay? It's probably your cheap internet, JT. That's probably what it is, but...
You're coming in clear, very
Yeah,
clear to me.
okay. And you're in Ireland right now, so, it's not like you're around the corner. Anyways, yeah, it must be your cheap internet, JT. Yeah, your internet fixed itself, so it probably was slowing down. You probably have Time Warner. I would go with Fios. Verizon's got a all fiber optic network now, and that's pretty good if it's available. That's pretty strong normally. Let's see. Let's go back to some questions. So I think you have to watch out here for a possible break. Just some choppy action. So you're back at the top of the range. So chasing anything here is not going to work. And if you catch a trade like this and you see the undercut and rally and it turns, it's not that easy to play because you gap up off the lows and there's no volume on the way up. And so that's why I think it could be vulnerable to failure. And one of the reasons why I'm actually short BABA here on this trip up to the upside, because I think we could come in. I thought it was viable yesterday along the 10-day, 20-day, which it was, and it moved up a couple of bucks. But in this market, I'm as ready to flip from long to short on the same name at any point in time. And a good example would also be Facebook, which is you get this fills the gap. We've talked about this. You fill the gap down here. Here, let me pull out my pens just because I love them so much. Anybody want to vote for a pen color? All right, we'll go with green. All right. Anyways, you fill the gap here, and that triggers a rally. You don't quite get to the 200-day line, but it triggers a rally. You gap up the next day, and you move up to the 20-day. You run into some resistance. Now you pull into the 10-day, and this is what I call the old nip and tuck, where you pull down into the 10-day line, and you hold here on what I think is I think minus 38%, something like that. It's a voodoo volume signature. You guys all know what that is. Volume dries up extremely, or in the extreme rather, and then you pop out of there on this nice, it's a 5-day pocket pivot, but remember, I like to see 5-day pocket pivots in clusters in lieu of a single 10-day. So, it's always nice to have a single 10-day because it does all the work in one day. But if I'm seeing like a cluster of 2 or 3 or 4 more 5-day pocket pivots, I've noticed that can be meaningful within the context of the chart. So there's nothing really automatic about it. And I think these days there's nothing really automatic about buying regular pocket pivots either. If you see them, they're generally just a sign of strength in the short term, and then you look to buy that stock when it shows some weakness. Anyways, but you can see now it comes up into the underside of the base here, and that's going to present some resistance even though it got just above the 50-day moving average. So you could come back in and short this this morning right here. So if you're nimble and you're using a 620 chart, let's take a look at that actually real quick, see how that would have worked. And you can see the cross early in the day. You had already crossed on the MACD down here. You crossed on basically right after the open. Within 5 minutes of the open, you cross lower, and so it could have been shorted right out the open, and boom, it's breaking down. You got a point on the downside. Like I've said before, you can make a living day trading FB for Facebook for a point or two every day. But it had a nice move yesterday, and pulling into the 10-day line, as volume dried up. So that's a little nip and tuck. It's also sort of a Wyckoffean retest because you make a low and then you're trying to come back, testing the low. You're well above it, okay, but the volume dries up. That's a Wyckoffean kind of retest. At least that's what I call it. But the basic idea is it's a test for supply where you make a low, you're coming back, you're seeing if there's any more sellers, suppliers, people are going to sell you stock, and there's no sellers, so the thing turns back to the upside and goes higher. And that's a basic test for supply, but I call it a Wyckoffean retest, whatever you want to call it. Same concept, but it leads to a rally back up to the 50-day. If you consider that Facebook is a late-stage failed base, so if this is your base in here and it failed here, it's now below the 50-day, and it's, as of right now, it's back below the 50-day, so it's still weak. So you could still look at this as a potential late-stage failed base short sale setup at the 50-day line. You could still look at it that way. And it's hard to look at something long one day and short the other day for most people. I've gotten so used to it, I'm wondering how I'm ever going to be able to look at a stock as just a long or a short for any period of time, because in this market they shift a lot. But I was able to adjust to this market, so I'm assuming when we get back to trending markets, if we ever get back to trending markets, I'll be able to adjust back and do what needs to be done. But I think you're going to need secular flows into the market to get out of this big choppy range. In the meantime, you know what you're dealing with, so stop whining and deal with it. So not that anybody's whining, but I hear a lot of people talking about how tough the market is and how some guy was commenting to me this morning that he buys, he'll buy a breakout or something and then stick to the 7-8% stop loss or hold it for a big gain. Well, in this market, what does that usually mean then? It means even if you get a nice gain, that's not a big gain, you're going to get stopped out for a loss. Do that over and over again, and you're going to start losing a lot of money. So you've got to swing trade this market. Anyways, BMRM looks like a viable gap up. Yeah, the only problem with this is you're in this position, and the second problem is that you're bumping into the 200-day line in the top of this range. So I don't know. If you wanted to try it, you could try it, but I don't know if it's necessarily going to work. You got to consider that there are some factors here that might be negatives. Dr. K, what's your take on this?
Yeah, generally speaking, bottom fishing Bible gap ups have a higher failure rate. So I would avoid this one because it's kind of coming up off its lows, and it's also almost at the 200-day, and it's also biotech. So it's got a lot of things going against it. Meanwhile, the pocket pivots, I still prefer the ones that are showing strength in a company that has good fundamentals. But that said, this is the kind of market where a pocket pivot off its lows, especially after some voodoo action, can work, but expect a swing trade out of it because it's probably going to work for maybe, if it works, it's going to work for maybe 2 or 3 days, and you can get, you may get 5 to 10% out of it, which is great, and then take your profits. But with Bible gap ups, I don't see the same kind of correlation because it's kind of like they've already made their gap up move, and there's a lot of weight on the stock, a lot of selling pressure on the stock that is liable to push it back down, and so that just gets stopped out.
Yeah, I think in this case, I can't get excited here, but you could try it. If you look at even one that looked pretty good last week, I guess. But you also have to consider here when this gap up in Mobileye, this actually would have worked on the day of the gap up because it opened right down at the lows and ran up about 8% from there, which I think if you were smart and bought it there, you would have taken that. And it's come in, but it's in a very extended position because it really bottomed here, undercut this low, turned and rallied. You got a pocket pivot here at the 200-day line. And right here, and then you moved higher. You pulled in with the market, so it was sitting right there on Brexit Monday, which is the day after Brexit Friday. And here, I'm going to draw a nice arrow there. How's that? Looks like something Hunter S. Thompson would be doing, would have drawn. But in any case, you get the idea. You get the bottom here, and so you get the big jack. And if you got long in here, you were on board for this gap up. But I think, once it got up here, you got to be selling this thing because you got, almost a 20% gain, I think. In fact, you do have a 20% gain if you bought it here. So you've got to take that, even if it is a gap up. Now, it's coming in. I think it's probably going to fill the gap or hold at the 10-day, assuming it does. So I'm watching this. I actually came in long this. I was buying some along the lows yesterday, and it didn't hold. I sold out at like 40, what would have been 44.66. So I didn't really give it much room because I figured if it doesn't hold, if it doesn't come out of here, it's going to either hit the 10-day, which you can't see now because I've covered it in green. It sort of looks like what my kids used to draw on the wall when they were babies. Anyways. but it's either going to hit the 10-day here, which it's close to. You're at 43.41 on that. The 20 days down here, that might fill the gap. That's a possibility. But I think now that didn't work, I'm just going to back away and wait and see how it plays out. And you have to be patient too. If you miss a move in a stock, I wouldn't feel like you have to chase it at all. I think you're a fool if you try and chase anything in this market. So you just wait and wait for another point to show up. And you know what? In this market, they generally do. If you're patient, you get another buy point. So as long as you don't chase things, you don't get yourself in trouble, and you're got a good profit cushion for the year. I'm assuming everybody here does. And you can test them out on the pullbacks and just wait. Just wait for your shot. And when it's there, you got to take it. Give you a great example of one here. I mean, that's how you have to play this market. This is a stock I think is interesting. And yesterday it was coming in right to the 20-day. I've been watching this thing. I haven't bought it. Then I saw it hit the 20-day. At that point, it becomes viable. Boom. And you're sitting there. It's like, okay, if you buy it, you're buying it around 35.58, something like that, 35.50 on as it comes into the 20-day line. And you figure, okay, where's my out point? Well, I would say it would have to hold within about 1% or 2% of the 20-day line. And so then you get the move. But you got to hold your nose, close your eyes, and buy the stock there, and then you get a nice move. But guess what? That's running up about close to like 8%, 7-8%, and it's breaking to a new high, so you take that. But that's how you have to buy them. Just like if you really wanted to make some decent money over the past week, you had to buy on Brexit Monday, which again is the Monday after Brexit Friday, which was the first day of the 2-day sell-off, that you see in every chart here has 2 big bars to the downside. Notice how this guy got some support off the low. So he's finding support. He's coming out of this big base. Now either this is a massive pod, but I don't think so because it's trying to come out of this huge structure. He came public back here in 2014, I believe it was, and this stock is building this huge structure. And I'm just wondering, could this be setting up for further upside in a good market? So that's one to keep an eye on, I think, maybe. But it just shows you how in this market, if you're going to buy anything, you got to buy things on pullbacks. Let's get another question in here. Somebody says, since the markets are bifurcated and rotate frequently from defensive stocks, value stocks, and growth stocks, do you have a methodology to identify early on value stocks? For example, recently I bought into Whirlpool at a bottom, and it ran up 24% from there. Which bottom would that be? This bottom? Or this bottom? I guess talking about the bottom there. Well, I think number one, you got kind of lucky, and I'm just looking for bottom fishing, pocket pivots, and stuff like that to pick up stocks. And I don't really discriminate against the type of stock necessarily. Whirlpool is a name that can be a growth name, and it has in the past. In fact, if you look at this pattern, it had a nice move. So it was sort of a growth name. And during the housing boom, I think it had a really good move back then. Let's take a look real quick. Let's go to a monthly chart here. Well, I'm full of baloney. Well, it did trend higher. It was a later stage mover. It broke out in 2007, right before the market topped. So, but it can have decent price moves, as it did in here. So, but I wouldn't say that any of my methods are geared towards buying growth or value or whatever. They're mostly technical setups, and I don't pay a lot of attention to fundamentals these days. You would have missed Tesla. You would have missed Solar City. You would have missed half the cloud names like Salesforce.com on the way up. You would have missed this great move in Twilio over the last few days if you were worried about earnings. You would have missed a nice jack and square way back in March when it broke out of a cup with handle, pulled in one time, and then launched 30-something% in 5 days. So, I think if you're trying to classify things as value, defensive, whatever, names that I've liked and I thought have been tradable, Raytheon is a defensive stock. My old flame that I bought in September of 2001, right after the markets reopened following 9/11, that one's broken out. And the volume is pretty good on the breakout 4 days ago, so it's hanging tight. Pull back to the 10-day, maybe it's viable. I've noticed other defense stocks, not defensive, but defense stocks, as in defense contractors, as in the military industrial complex. they've all been doing pretty well, and I got to wonder why. So,
I was going to say, your screens you run will naturally show you where the money's flowing. I've never tried to anticipate any sector ahead of time or trying to see, which sectors. You can see which sectors are outperforming. There's nothing wrong with that. But in terms of running screens, the obvious stocks just start to show themselves, like the solars did in 2007, or you had the oils back in 1997. I mean, that was an unusual group because they had never really done much of anything for many years, at least at the time that I'd been trading the markets. And nevertheless, in 97, we all started to go on these streaks, hot streaks. So just running your screens, what we do is we run the screens diligently throughout the day, and so we're going to see subtle, minute changes that might otherwise go undetected. And if enough of these stocks from a particular group start to show themselves and start to get placed on my leaders list or Gil's leaders list, then there's a clue. Something's going well for this particular group.
let me show you. You're asking, do you have any methodology for value stocks? And as I said, my methodology doesn't vary based on what you want to classify the stock or anything that you would consider fundamental. But if you look at this, there are ways. So I use technicals. That's what I use to identify stocks that are going to potentially bottom and turn higher. And there's a lot of ways to do this. First of all, you got a low here, and I'm assuming this is the bottom you bought, and then you retest here. But notice on the retest, the volume isn't all that heavy, and you undercut this set of lows right along here. So now that sets up a little undercut and rally. Boom, you undercut, and you rally back to the upside. Now, so you see that's constructive. Now, if you notice very carefully, you see this day right here. I'm going to draw a nice clean arrow, and you see that day that corresponds to this day right here. And what is that? Anybody want to answer the question? That's a bottom fishing pocket pivot. So you could theoretically, that would be your bottoming signal. If you liked Whirlpool, if you're a value stock kind of buyer and you look at value or whatever, and that's a factor in your analysis, and this stock fits what you're looking for in that sense. I mean, speaking for myself, it wouldn't be something I would look at, but I might look at this based on the technicals. But if you feel strongly about the stock as being value down here, then you're looking for something technically to tell you that it may be trending back to the upside. There it is. It's a bottom fishing pocket pivot, also known as a BFPP. A boot. Say that. If you can pronounce that, you win a special prize. Got it? So that's what it is. It's and you buy it off the lows. And it turns and goes higher. And so that's our methodology for identifying any stock, whether it's a defensive, value, deep value, growth, hyper growth, trendless growth, whatever. You got any other good categories for stocks, Dr. K, that are meaningless but interesting? Okay. Okay, let's go on to some more questions. That's a good question, though. But again, it sort of demonstrates how people, instead of seeing what's right in front of them, so we're constantly talking about these roundabout and bottom fishing pocket pivots as potentially telling you when a stock is bottoming or turning off the lows after a downtrend or while building a new base. But you can't see that on its face as a method that could be applied to value stocks as well. Instead, you're looking for something else that you think has to fit in categorically with the concept of buying value stocks, when really it's all about technicals. And it doesn't matter what you're buying. So if you can understand that, you can pretty much buy anything your little heart desires, and as long as you know where your stop is. Anyways, but it's interesting how people, the answer you're looking for has been right in front of you if you've been watching these webinars for a long time, but you don't want to see what's right in front of you. You want to start trying to see something else. And sometimes it's that simple, so think about that. Anyways. Back to my list of questions here. Addendum on WHR, when I bought in, is down minus 25% for the last 12 months. So you bought it in January, yeah. So but that's at the low. Wow, that's pretty good. If you have a method for buying the exact low in a stock, please let us know what that is. Just send us an email. We'll be happy to tell everybody all about it. Somebody says they bought BMRN before the gap up and sold it today. Yeah, that makes sense. Does UNR work in all time frames, daily as well as intraday? Sure it can, because yesterday, if you were paying real close attention, I saw this, and I thought it was quite interesting. if we look at the S&P, for example, on the 5-minute chart, and you also have to remember this is somewhat contextual. This is the opening right here. And I want you to remember that you're going to try and put these side by side. Well, nah, I really can't do that. So let's just note the level of the where's my data window? Okay, the 50-day moving average yesterday was at I can't see it. Was at 2076.83. Okay, so notice here on this 620 chart, and this is for yesterday, that would have been right around here, somewhere right around there, somewhere. Not maybe up here, somewhere. Let's just say somewhere in here. Okay. So draw this line across. So you can see that the first low happens right after the opening. This is the opening bar right here. So boom, we're gapping down, and we come down 2 bars. Notice how the bars compress a little bit, and you're getting some lower tails, and then you get a little bit of a doji here, or a spinning top rather. So that's telling you that you're coming down, but maybe sellers are starting to diminish, and the market's starting to hold. You can see the volume decline slightly in here. Okay, so and that just barely undercuts the 50-day line. So it initially looks bearish because it's breaking the 50-day line, but these days, as I've said many times, I don't look at, and I would say not just these days, but throughout my career, I've never looked at a moving average as a solid line. It's kind of a fuzzy zone. So I use, in that sense, it becomes a quantum moving average. So. And so, something can undercut the 50-day and they'll fake everybody out. All the idiots who set their sell programs to hit once the thing dips below the 50-day. And maybe that is what happens. So you run up off the lows for about 20 minutes, 15, 20 minutes. Well, let's see, 25 minutes, 20 minutes, and then you reverse somewhere in there. And you come down, you undercut the low again, you also cut the 50-day. Now it's really looking bad, okay? And longs are starting to get a little wigged out. The shorts are getting excited. But what you really see if you step back and look at this objectively is you see an intraday undercut at the same time that the S&P is undercutting the 50-day line, and just barely, and enough to qualify as being within the fuzzy zone of the 50-day moving average. But you can see this happen on the 620 chart. So yeah, undercuts can work within a context of, say, an index coming into its 50-day moving average. So you don't just use it in a vacuum. The 620 chart is usually used when I'm looking at undercuts, or I'm looking at things reaching an extended upside point where they might start to reverse, then they're running into resistance. So to answer your question, yes, it'll work in, I don't know about weekly. I've never really used it in weekly, but it definitely works in 5-minute and 1-day time frames. So mobile, I just tested that low 43 area. There it is, holding the 10-day line. Does that make it a buy? Check your volume level here, I would as well. Let's go, whoops. I got to update this intraday real quickly.
74%.
Above average?
Yeah.
Yeah, see, that's not really what I want to see here. I want to see volume drawing up on the pullback, so maybe it needs to come in just a little bit more, at least some kind of supporting action. Let's take a look. This is a good example, actually, to look at. Here's what the 620 shows. So you got a big volume breakdown here. So somebody's dumping this thing, it looks like, and unless it's for rebalancing, this would concern me. So you're not, you had an extreme sell-off here on heavy volume, so naturally the market makers, if they're taking that down there, they're going to absorb this seller and then they're going to let it jack. And on that basis, I would be very cautious about buying this. I don't, I'm laying back, because the other thing here, and this is a trap you'll fall into in this market as well, or in any market, is you see that, okay? But that should not be telling you, like, oh my God, that means we're going here. We're going off the screen, up to the upside, beyond the top of my screen, way beyond it, and it's going to happen tomorrow. that sort of thinking, if you're thinking that way, you are a moron, okay? Because the thing you need to understand is this is pretty extended by this point. So that's why I'm saying if you were lucky enough to buy here and sell into the gap up day up there around 48, 49, you made a nice profit, and you should be taking that profit rather than thinking you're going to be a pig and sit for the big gain. Now, longer term, maybe Mobileye has some potential here, but if it's short term, it's very extended off of this low. And so it's not just, if it holds in tight, that would be great, but it's not. You know, if it held in tight, that would maybe tell you something, but it's not. It's coming in, you got volume running above average. It's trying to hold the 10-day, so a lot of monkeys see the 10-day line, they're going to buy it right there, but it may not be ready because the volume is, the selling volume, you can see that on the 5-minute chart, is pretty heavy. So, you know, I don't care if I buy it 50 cents higher, I'm going to buy this thing when it turns. Not when it's getting beaten to a pulp and I need to sit there enduring that, okay? I don't really like to do that, and I generally don't do it. Now, if you want to try and buy it here and do it, go ahead, and maybe you'll be successful, but I'll wait. I'll wait just a little bit. Maybe I want to see a 620 turn. You're kind of getting a MACD stretch a little bit, but the one thing that concerns me is that somebody's hitting this thing. That's a lot of volume. And I don't think I want to stand in the way just yet, okay? So, you know, make your own choice. If you're a macho man or a macho woman, you can buy it there and, you know, make it last stand. Yeah, Dr. K, go ahead.
This is not a bottom fishing Bible gap up, as we were discussing earlier, but it's also not the highest quality one either. So you kind of weigh that into account, take that into account. It's got a great story, but it needs to now prove itself.
You need to consolidate that. You know, yeah, that's too much too fast. And in this market, what is that, Dr. K? You go from 34 to 49. What is that?
It's a huge gain. It's like almost 50%.
Yeah, so, you know, it's like, what do you want? I'm going to choke myself on that one. Excuse me. Even from, excuse me again, even from here you got 20% up to 49. So it's like, what the hell do you want, you know? But it's interesting how people will see that, and then they just got to be all over. Now I'll test it if it holds tight, because if you notice that the prior 2 days, it just undercut the lows here, but it held the lows and then closed above, or never got as far as the intraday low of the prior day. See that? So in this case, yeah, let's make it really big. You can see that here. I hope this is helpful. You can see that here you make a low intraday and you close off the lows up here. But the next day you come down again, but you hold a little above this low and you close up off the lows just a bit. And now today you're going bonk and the volume is picking up. You're at the 10-day line. Here's the gap. So the gap is just above, say I'm going to say 42, just above 42 bucks. What is that? The high here is 42.17. So maybe it'll hold, but yeah, I don't know. We'll see. You know, another thing I want to point out is that this is a tough market. You see some nice moves, but from a psychological standpoint, and even from a standpoint of your methodologies, being able to capitalize them in a big way. You know, in other words, I can't go 100% long 2 different stocks and be full on margin, 200% on margin. I can't do that these days. So the only thing you can do is take as big a position as you can tolerate at a buy spot. You know, and a lot of times you're buying the thing at the time that the market's looking pretty ugly. So it's difficult to do. So it's not easy. I'm just noticing Weibo is up a couple of bucks. That's the Chinese Twitter. Look, that's a breakout. It's gonna break out. But you could see you had like a pocket pivot, a 5-day pocket pivot in there. It pulled in, volume dried up. This actually hit my Voodoo screen yesterday, believe it or not. And now it's jacking to the upside. Is there some news on it? See anything, Dr. K?
I'll just check now, unless someone already knows.
That's been a great name. I mean, we put that one on our list here on the pocket pivot, and it has never looked back. So that's actually been a trending name. It goes higher, and it sets up in a base, and it goes higher, and you might say this is a base on a base. So that one's looking good, although I wouldn't be buying it on the breakout. I actually thought it was viable right in here on the volume dry up right there. You can see that. And if you understand our methods in this market, the madness to our methods or something like that. Whoops, not a highlighter. We want a pen. That would have been right. See this day? That's a voodoo pullback because you're lower than minus 35 and you're holding tight right at the 10-day. So that was a buy spot. And boom, you get a nice move. 10% to the upside from there. You probably want to take it. Why not?
I don't see any use on it.
Yeah, so it's breaking out, and I would prefer to buy it on a pullback, but this was the last really good buy point in my view. Notice also that on Brexit Monday, which was here, that the stock held very tight. It just barely undercut that low. So within the base, you know, another great way to buy, I think, is on an undercut and rally within a constructive base. So stock doesn't have to be, you know, making new lows like a lot of these things were, but it could also be forming a base, and then it just on a weak market day undercuts the lows of that base. And a lot of times that can be a reasonable buy point. Market's starting to sell off more. Like I said, I think it can come in here because we're back to pre-Brexit land, and now the market needs to figure out all the other terrible things that loom ahead, which is the slowdown in the global economy, slowdown in the U.S. economy, because some people are saying that correct me if I'm wrong on this, Dr. Guy, I think I read something the other day that the current interest rate configuration on the yield curve and whatnot is predicting a recession for the U.S. within the next year. So,
yeah.
You know. So, you know, there's that.
It's interesting. I just want to comment on WB. It's like the old school market, the pre-QE market, in that well, yeah, it's obeying the 20-day without violating it, and it just keeps going higher. So yeah, it's kind of a rarity to see one of these names actually work. So that's why the shorter-term horizons tend to work a lot better in this environment.
And you can get a decent move. I mean, if you had sold into this move, you get a breakout, you get a nice move, and then you could have bought back on the undercut here. That's feasible in here on the tightness. So, you know, in some stocks this can work, but it's not, you know, how often do you see this work like this? So that's the other part. It's not like it's the 1990s. That was definitely a target-rich environment for anybody who was there. Somebody says, the person who asked about Whirlpool says it wasn't luck, studied stock closely for a while, several catalysts existed along with study of fundamentals and technicals. That's good. That's so if that's your method and that's what you do and you like it and you find it effective, you know, everybody's got to find themselves as a trader. And then if you can incorporate some of our methods in terms of confirming on the technicals what you're seeing from a fundamental standpoint or value standpoint, then I think it adds power to your method. Wouldn't you agree? You may answer that with an I am back. Anyways, so let's look at some other stuff. Fabrinet, we only have a few minutes left. Here's one. This undercut a low bounce off the 50-day. It looks like it's in a viable spot, but that depends on what the market does. We're starting to turn red. Don't be surprised if we come in a bit here and just remain really choppy. Market starts to look very bullish. I know yesterday you had this outside reversal to the upside, which looks bullish, but within the overall context, it's constructive and just tells you that, you know, people who missed this are trying to buy back in because now they're thinking that the Brexit is over and it was all a big fake out and a shakeout, or it could just be part of this big choppy range we've been in for the last 3 months. So I think that's what you're looking at. What do you think about Twilio? Well, I think Twilio, I actually thought this was buyable right here. And I know this sounds really radical, but you know, you got to use all your tricks. What I see here is it comes out, it's very popular. This is actually a very interesting company. You guys should check it out. Go on their website. They make apps that allow you to make apps. I think that's what it is. And they're basically apps that allow companies to send instant messages to their customers. It's something we might look at maybe if it's not too expensive, but it's very interesting. I would just go read up on it on the internet. So I think it has potential. They're losing money. But you had, the thing was very, I think it came public at what, 15 bucks or something like that? What did it come public at, Dr. K?
At 15.
Yeah, they opened the thing up at like 26, I think it was, or no, you can see right here, they open it up here at 24, and it jacks to 29, and it pulls in for a couple days, volume dries up. Now, see, that's what I now call relative voodoo. So you see a huge jack, holds up for 2 days, a very hot IPO, boom, you get a nice move. Look at that move, that's huge. That's like, what is that, 30, no way, what is that, from 20 7 to 42. What is that, Dr. K? Is that that's not a double. It's close.
No, it's 50% gain.
Pardon me?
It's more than a 50% gain.
Yeah,
so it's substantial.
42. Yeah, so it's like 14, 15 points on 20. Yeah, it's huge. In just 4 days, 3 days. And then, of course, you would have probably sold maybe in here, but, you know, why be a pig? Then it pulls in again, and your volume dries up again. So, and then it dries up more than this day, just barely. But it does, and it holds right here. I was looking at this last couple of days, and, you know, tomorrow we're going to get a 10-day moving average on the thing. So once you get another bar here, there's going to be a 10-day moving average. It'll look like the way I draw them. It's going to look like this. Like that. It'll just be some little thing, or maybe it's down here, and it'll start to show, but then it gives you some reference point for a pullback, so, you know, viable pullback. So, let's see, Mobileye 43.25, it's not happening, you guys, you see that? So, you know, you can see what's happening on the intraday chart, you know, and that's not what you want to see. So, I just say bye-bye. You know, I got out over a point and 40-something cents ago, so I'm pretty happy. I gave it a shot. I played part of the move. I sold it before the gap up, but I played part of that move off the lows there, and that worked. And that's the other thing about this market. You're going to get some trades. You really don't know how far they're going to go. I mean, like this one, if you bought here, if you're some maniac buying there, and it gets here, I'd be taking that profit. And then, of course, you'd watch it go here, and you might be pissed off, but you should be happy you caught the thing in the first place. And then it sets up again, and now you get another move. I saw this thing trading yesterday, I think it was. No, that's another one. But this one, I watched it come in yesterday down at the lows, and I thought, wondering if this is, and the volume I think was low early in the day, and was wondering if it was viable. But it's not marginable, so you can mess up your margin with that, buying that intraday and trying to trade it the way I might. But in any case, another one is this one. Now this just became marginable the last couple of days, and it's moved to new highs. I watched this trade between 40 and 41 all day yesterday, and then in the last half hour it suddenly launched up to 42.89, and now today it's gone higher, but that's getting a bit extended. But this is a very strong story. They're basically the leading edge of fiber optic technology right now, next generation 100 gig plus technology for the fiber optics space, or whatever you want to call it. But in any case, I'm just looking at a pretty chart here. Notice how you came down, you undercut these lows on Brexit Monday, and that was an undercut and rally. From there, boom, we're off and running. But this is one I think, if we ever get into a normal market again, it's one to keep an eye on, I think. They have great earnings. Maybe this is it. Maybe now it just does what a lot of these other IPOs do and just tanks. Anyways, that was my take on Twilio. That's interesting. The person talking about Whirlpool says, I agree, I listen to you guys for more value-added information to my methodology and some confirmation. I find value stocks are more difficult to pick up on even using multiple methods. I've been doing this for over 30 years. Just trying to learn. That's now you're an example to everybody there. Doing this for 30 years and you still recognize that you're still learning, and I don't think you ever stop learning. So that's what makes it so much fun. It's like an infinite Rubik's Cube puzzle. Once you solve it, it has to be solved again. Anyways, we're almost to the end of our program today. What else? Like, you know, here's some names. I don't know. Are these shortable? This Workday, possibly. Salesforce, possibly. I actually shorted this one this morning, believe it or not. And basically I watched this make a couple of highs in here, and it looks like it might be getting to the top. It looks to me like, and this is probably a little radical, and I'm using some of my newer methods for shorting that I'm not going to go into right now because it's proprietary, but you're looking at something of a poddy-like pattern, so that we'll see. Anyways, it's one. But you know, just running through some of my short ideas. Microsoft underneath the 200-day, is that going to go somewhere? Expedia, yeah, it's under the 50-day. You can see these undercut and rally moves have all taken a lot of these stocks into areas of overhead resistance. And you got to remember, while the undercut and rally is playable as a long trade, briefly, it's only recently in the QE market that I've adapted this to use for long trades, when before all I was doing was using an undercut as a point at which to cover a short position that was coming down and then looking to reshort on the rally once it gave way. In a QE market, though, I've noticed that undercut and rally sometimes can lead to bigger rallies and sometimes substantial rallies. I mean, you go back and you look at something like Alaska Air, there's an undercut and rally, and that led to a substantial rally from there. So it can happen, and it seems to work pretty well in a QE market. But again, that's a QE market. You know, in the past, something like that, you wouldn't touch that with a 10-foot pole. So, but in this market, I think a lot of setups become viable. And if you want to make money in this market, I think number one, you have to trade, and if you're going to be trading more actively, you need as many setups at your disposal as you can use. So that's why I like the value approach, because that allows you to use the technicals that we use along with if you have developed a good knowledge of dealing with the value side. I think that can work wonders, especially in this market. And remember that there's also, when you think about technical support levels, there also is another phenomenon, and institutional guys used to talk about this when I was at O'Neill, and we used to advise them, there's also fundamental support levels. So there are price levels where there is support for something on a fundamental basis and not just technical. So that's something else that exists out there in the way that some people think about the market. And I've known a number of outstanding value buyers, or I knew a number when I was at O'Neill. They used to use our stuff, and one of the things they really liked was the way the O'Neill charts, the weekly charts, they tracked the earnings line, and the earnings line was calibrated to run through the chart at what would be 20 times earnings. So whatever price would be 20 times those earnings, that's where it would be plotted on the chart. So a value buyer would look at something, and that's often been considered a market multiple, at least it was in the growth days. And so a lot of value buyers will look at the stock. If it's trading, 50% below that earnings line, then they're going to start looking at it, and they could flip through charts and see stuff like that, and then go in and do more detailed analysis. So that was useful, and that sort of thing is kind of common now. Back then, that was an innovation that O'Neill had on his weekly charts, and that's how value guys dealt with them. Last week we talked about this 2U, and that's a breakout today. Looks like it's going to trade enough volume for one. That's interesting. Very nice. That's a decent breakout too, but I'm not going to chase it. We talked about it last week, and I think you want to be buying it along the 20-day and the 10-day, not necessarily in that order, but you want to be buying them along there. So, but that's a nice breakout, Scotty. Did you buy it along the 20-day? Did you? He's not answering. He didn't buy it. Okay. Look at Ambarella. I mean, this one had a nice move, and now it needed some time to sort itself out and consolidate this sharp move. And this is a bottom fishing Bible gap up that has worked, but it held. So, like I said, you could test these things, and what I figured here is this would probably lead to a rally up to the 200-day line. It went past, so I was wrong there. And then it's bounced along the 200-day line. And I believe that it just barely, yesterday, 48.77, 48.78, and this low is 48.80. So it undercut that low right here. It was just above the 200-day line. Now it's moving higher. So that name looks pretty decent. Let's look around here. I notice Splunk is holding up. There's some talk of Amazon buying them, but notice how this is undercut and rally. It undercut this low, rally, and now you're running it at the 20-day line. Is that a short at that point? So you're sort of at a point of no return in terms of, well, it could return to the downside, but just in terms of a critical point where if it can get above the 20-day line, maybe it gets back up here. It was acting well before the Brexit sellout, and it has not rallied back like the market has, which I don't know if that's a problem. Maybe it is. But in any case, you can see that this is running right up in there. Maybe it's, I've been long this one on the undercut and rally, and I sold this today, and we'll just see, since I sold, it's probably going to go back to 60, but we'll see. What else? Have you seen gold mining? Well, I've been bullish on gold miners for a long time. You know, silver Wheaton, he had a gap up breakout here and it's gone higher. Had a gap up breakout here and it's gone higher. I mean, I've been bullish on gold for a long time, and you see you have a gap up break up here, but we've seen these, you know, that's been slow going. So now are these going to suddenly develop a lot of upside momentum? I think you had to buy, and I've talked about this in the webinars over and over again, if you're going to buy gold or silver, you're buying it on a fundamental thesis. You're not buying it necessarily on technicals, because if you buy these when they're up, they tend to come in, and you have to buy them when they look ugly and maybe at areas of support. So what is that? Stock twits. Oh, this will let you go to stock twits. You know, silver's coming in, but I think if you pulled into the 10-day, that's where you'd look at it. But you know why this is happening, because the Fed is on hold, and the precious metals are telling you that. Either that or there's no confidence in central banks, which could also be a part of it. But that's all the macro stuff. I'll leave that to Dr. K. But I think there is some of that going on. But keep in mind one thing, is that if we do get into a bad bear market and they start selling everything, then they're going to take the metals down and the metal stocks down with it all, and that's what happened in 2008. So you know, you can't be smug and complacent. I have a long-term position in gold that I took in the year 2000. I added to it again, I believe, on a pullback to like in the 830s, I think it was, back in 09 or 2010, something like that. I forget, maybe 08. You have to go back and look at the chart, but I've held that position for all that time, so I guess it makes me a long-term investor. And I think it's still going higher. So it's just a matter of sitting with it long term, and mainly because, as Dr. K has said many times, the central banks just keep printing, and they're sort of stuck, right, Dr. K? They are stuck.
Yeah, so reflected in the price of silver and gold. Obviously, you know, when central banks say they're going to print more money, like the Bank of England has done recently, and the ECB, and then now the Fed in their minutes, you know, saying that they're going to leave rates on hold and wait for more data. That's good news for precious metals.
Yeah, so I think the long-term case for the metals is intact, and you know, I'm still way up on my cost basis several times, and so I'm just sitting. So my initial thesis back then has been proven correct, and I'm staying with it because, as far as I'm concerned, so far it hasn't been proven otherwise, and QE has really reinforced that whole thing. So anyways, that's why I'm surprised with QE after 2009, 2010, with the way QE has just continually gone, that gold prices aren't over 2,000 and silver isn't trading back at 50. Maybe that's where they're headed. Who knows? But I think there's also a lot of manipulation that goes in the markets, since we know that for every ounce of physical gold, there's 100 ounces in paper gold or contracts related to that. So if there ever really was a run on physical gold, you probably would see the price jack considerably higher. Anyways, hey, on that note, we'll close with a brilliant quote from one of the webinar attendees. My golden investment is in VoSI. Sure. Anyways, on that note, you guys, hopefully this was useful in giving you some perspective on where we're at, but I definitely would keep an eye on your short sale watch list and some of the names that we put reports out on as short sales, because they may be rallying into areas of resistance that could bring them back into play if the market rolls over. And I still think you're in a trader's market. It's volatile, but it is a trader's market, and you have to be willing to move with it. So on that note, that's all we got. You guys have a great weekend, and we'll catch you next week.
So long, everyone.